needle on the record.
Welcome to Wage Cucking with JMO.
All right, guys. Welcome to a new episode of Wage Cucking with JMO. Had some time off. It's been like a few months, I think, since I've done an episode. But I figured I owed one out, and I'll try to get more of them out in the future, possibly with guests, or possibly in this format, or possibly with Blake and Andreas joining and just talking about random stuff. So I guess for this episode, I asked some Twitter questions I asked for some Twitter questions and got a few responses. I was going to go through a decent number of those and discuss my thoughts on the current crypto environment. But before, I think what I want to do is, before we get started with the individual questions, a lot of them, I read through a bunch of them. A lot of them had basically were basically the same question, or had like the same undertone, or wanted like a response to the same general topic. So maybe I'll break those down first. I wrote down like 4 topics. Coincidentally enough, a lot of these topics are about guests that were previously on this podcast. So possibly I might be a little bit biased in my takes, just because, like, I might have some history with them, but well, let's discuss them. So the first thing is Ethena. I got a lot of questions about Ethena as to, like, what are my thoughts on it now that Ethena is launched. It went from basically nothing to like over $1 billion market cap overnight. The market took a turn a bit, where Ethena, for those who are not up to date, basically is a synthetic stablecoin that leverages its yield from a basis trade. Basically, you deposit Ethereum, you get the rewards for staking your Ethereum. But then you also open up a 1x short on a perpetual contract with Ethereum. Generally, the idea is funding is positive in your favor, meaning that you're getting paid on both sides of this delta neutral position. Like it's a cash and carry trade, or a basis trade for people that like trade in traditional finance. It's been around for ages. So we did a podcast with a guy from Ethena. This was like, I want to say like a month and a half before the protocol actually launched. And we one of the things I wanted to do was just to talk through a lot of the risks, because whenever people try out new things in crypto, especially something that really hasn't been done before, especially to the scale, that there are going to be inherent risks. Like a large issue, I think, in crypto is the innovation can get a little bit stagnant, meaning we're sort of copy pasting old protocols, or we're not doing anything like new or revolutionary. We're sort of like repasting old code, or repasting old ideas in new formats. And I thought Ethena was like a good example of something that, I mean, it's sort of been done in the past with other protocols, but definitely not to this scale and to this degree and to this level of execution. So like, I was very interested to see how a project of this nature would come across. I'll preface this by also saying that I think there are inherent risks in Ethena. Like, if you ask me what's riskier to hold as a stable coin, the USDE or let's say USDT, I'd say USDT is like probably a decent amount safer, just because of its track record and the fact that it's not reliant on like a trade in the back end to hold its position. Rather, it's backed 1-to-1, or in theory backed 1-to-1 by US dollars. I think the current environment is a good stress test for Ethena right now, just because Ethena will always work in like a bull market where everyone's long and funding rates are going to be high, meaning like just holding the stable coin, you can identify the native yield just by looking at like the funding, the perpetuals. But when people start to turn bearish, when the markets start to turn more bearish, that is a pretty good stress test on the system, because like you get an idea of not only how the supply of USDE will grow and shrink based on these cycles, but also how like the team will respond. Like, for example, if there's like a prolonged period of negative funding, like what does the team do? Do they make adjustments? Do they do something with the protocol and stuff like that? And so far, I think everything has been going pretty well. Like I'd say at launch, it went from, I want to say, like $100 million market cap to like over $1 billion. I want to say like within like a week or maybe 2 weeks, which is like pretty insane for a protocol, which has like not really been launched and not really been tested to grow that quickly. I do have like a couple of issues or a couple of concerns. I'll get to those later, but the few things I'd like to say about them is the team is really good. I think like from Guy to Seraphim to everyone else like active on Twitter who are like responding to community feedback, responding to community criticism, figuring out like how to assess risk, how to mitigate risk, how to design the protocol in a way that will succeed long term. But then also, if you look at the execution of their launch and their points program, it's, in my opinion, one of the best launches so far, because not only have they executed a quick release token within their points program, but they also went out of their way to incorporate as many existing useful protocols in crypto, or like even some cross-chain functionality and stuff like that. So they integrated stuff like Curve, stuff like Morpho to source liquidity. They're offering USD on like various chains through bridging. They're offering like yield tokens on Pendle, and Pendle's like one of the fastest, if not the fastest growing DeFi protocol today. So I think the team and the execution are very good. A few issues I do see in the future is that a lot of the projections that they made were in a world without Ethena, meaning like they did a lot of research on how Ethena would operate, and basically they determined that like the periods of negative funding or the periods where like the stablecoin wasn't generating any yield was small, and a majority of the time the stablecoin would be generating yield, which makes sense. Like in order to launch a protocol like this, you want to look at historical data and make sure that the protocol does work. However, I don't even think they predicted that the protocol would blow up in terms of size this quickly. So in a world where Ethena exists, a lot of the previous data may not be like completely invalidated, but it may not be accurate. Meaning, if like Ethena constitutes, let's say like 10 to 15, I don't know what the number is right now, but let's say Ethena constitutes like the 10 to 15% of the global open interest, or at least the global short open interest. That would skew funding rates pretty heavily, considering like you have this huge market player that has like a one directional position at all times, and the previous data doesn't really account for that. The issue I see is like it seems like it's fine now, like it doesn't skew the rates too much, but as the protocol scales, it means that it will be a larger percentage of the global open interest. Meaning, like if the TVL doubles, let's say within like the next like month or 2 months, the open interest generated from Ethena might be like 20, 30, 40%, and that can skew rates dramatically. I haven't really heard like a good response as to how they would solve this issue. I just think that it's one of those protocols that has a hard cap as to like how large it can scale, and it's relative to like the amount of volume and then the amount of users using crypto. The one thing I do think they should do is, instead of advertising it as like a stable coin, I think a minor adjustment is advertising it as a basis trade and passing on the negative yield to the users or the stable coin holders or the token holders itself. So during times of negative funding where their yields are going to be negative, I think their general idea right now is to have an insurance fund and to like have a buffer. So when these times come, they'll have an insurance fund to have a buffer for the stablecoin so it doesn't fall off peg. But I don't think that's like very transparent. Whereas if it's just advertised as like, well, listen, basis trading might be tough, like executing a cash and carry trade might be tough. Like we have a huge team, we have the resources, we can execute it for you. You don't have to monitor it day to day. But there are some downside risks, and we'll pass like a portion of the downside risks on to you for using our service or holding a stablecoin. I think that might be a slightly better protocol design than what they're doing right now. Regardless, like yeah, I basically only really have like good things to say about Ethena and their team. I'm bullish for it in the future. Like again, it's still going to be, no matter what they do, it's still going to be like very market dependent as to whether they succeed. But I think they have everything in place, from like the user base, the team, like the everything about them sort of, gives me the green light, or checks certain boxes, where I don't have like any huge overarching concerns, just besides like the protocol design, how well it will scale, and like the current market environment for it. The second topic I got a lot of questions on was like the recent announcements for the EigenLayer and the LayerZero airdrops. Without getting into too many details, because I guess they're like a little bit different. I will say a few things. First, I think like the public is a bit too hurt right now, or a bit too, how would I describe this? Like essentially these protocols are providing like a free amount of money. Basically, all these points programs is if you restake with us, or if you tie up liquidity with us, or if you like or use our protocols, then eventually you'll get an airdrop for our token, and the token will have value, and likely you'll be making a bunch of money. I don't think any of these protocols actively went out and like even announced or said, or even hinted at like how much money you'd be making. Like they're not talking about like when our token launches, it'll be like at X market cap. So like the ROI of your position should be this. It's just people that like are looking at historical data, and like looking at comparable protocols, and extrapolating that data to figure out like if farming for these airdrops are worth it. And I feel like that's the current meta right now. However, when like an airdrop, or like a design of an airdrop, or the execution of an airdrop is underwhelming, you just see a bunch of like super hostile people on Twitter. Like for example, when the EigenLayer announcement came out, they accompanied the airdrop announcement with, I believe it was like a 50-page white paper explaining the technical details of EigenLayer. And I would say like 90% plus, maybe like 95% of the responses I saw was basically just like complaining about the lock, complaining that it's like non-transferable, rather than like, looking at their ideas, looking at their technology, because essentially that's the value of the points, or the token that you will receive. And I feel like it's not a good environment in crypto right now, where people are sort of past looking at stuff like that, and rather just want this immediate gratification of like, well, how much money am I getting for doing this? Where in reality, a lot of the activities that you are doing in order to farm these airdrops or farm these points aren't necessarily aligned with the overall long-term interests of the protocol. Like, so for example, if you're doing something like sibling, or you're making like multiple frivolous transactions in order to game the system, in order to gain the airdrop, and your net goal is to, when you receive the airdrop, possibly sell a majority of the airdrop back into some other form of currency, which is negative sell pressure on their token. And when the incentives aren't there for you to like use the chain, or use the bridge, or use whatever, you sort of abandon the protocol and go on to whatever else is giving out an airdrop. And I don't think that, like for example, if I was operating a protocol and I saw this happening, I would feel like I would be incentivized to disincentivize these people from using their the protocol itself, just because, yeah, it may gain it may bootstrap some adoption, bootstrap some liquidity, but in the long run, if like you're only there just to get the free money associated with the airdrop, and you're never going to use the protocol or the technology afterwards, it's not exactly the user that the protocol wants the token to be distributed to. I think that the interesting thing about the LayerZero airdrop is that they actively announced. I think this is like the first major airdrop that like openly announced this, but they were going to uh, really go after people that were sibling the airdrop. Sibling essentially meaning creating like a bunch of accounts or using a bunch of frivolous transactions in order to generate more points or to appear that you're, multiple entities using the protocol rather than just a single entity. And this got quite a bit of backlash, mainly because a lot of the protocols that were or potentially flagged by this, the protocols that use the LayerZero technology would be potentially flagged. So then you have users saying like, we're just using zero technology. We're using the protocols that use your technology, and we're still going to get flagged. I will say that I have full faith in LayerZero. Brian and the team there. We had Brian on the podcast like almost a year ago at this point. He's also, I've noticed he's also actively responding to like quite a few people that have issues with what they're doing with their airdrop. I don't know like the exact details of how the civil protection will work. I just know that there is going to be one, and you have the option to report for, I believe, 15% of your allocation, and then they'll have a bounty program as well where other people can like snitch on other users and gain a certain percentage of their allocation. Yeah, I don't know too much about like exactly what they're doing or like how the execution side works. But I, in general, agree with this idea that it's in the protocol's best interest to weed out the users that are attempting to game the system that don't actually add value to the protocol. And if this process is going to ruffle some feathers, it's going to leave people unhappy with the protocol, I think that's fine in the long run. Just because like the people that they're leaving unhappy, like I said before, aren't really the users that they're going to retain long term anyways. So it's sort of like a sunk cost here. And then the final thing is I feel this goes back to what I was talking about with Ethena, is that people are here for like sort of like now the current crypto environment is people here for like the instant gratification of like you do X, even you just because someone on Twitter like gave you a guide as to how to farm airdrops or do whatever, and you're like suddenly entitled to like this like large pile of money at the end of the rainbow or something like that. And I don't think that's how things should be, nor do I think that's like really sustainable. But I think that's another topic. I'll get to it later. The third thing I had written down and wanted to talk a little bit about is this is like, I want to say like a month old at this point, but I haven't done a podcast since then, and I wanted to talk about this, was the whole situation on Solana with marginfi, and to like a lesser extent, like a few of the other borrow lend protocols, Camino, Sollend. There was quite a bit of drama. I'm going to get some of the details incorrect on this just because it's been a while. But there was a time, I want to say this was around a month ago, when Solana's experienced quite a bit of performance degradation, meaning a lot of transactions that you inputted didn't go through or were delayed due to like something wrong with the chain and the chain being spammed. So one of the protocols that was hit hardest, I wouldn't say hardest, but one of the protocols that was affected quite a bit was marginfi. And previously in this podcast, we had Anders from marginfi on to talk about the protocol. I'm a big fan of the protocol. I think it's well designed. I think it's well run, but it did receive quite a bit of hate during this time. So basically the issue is like At certain points on marginfi, I believe you could still deposit collateral, or you can deposit it, but you couldn't withdraw collateral. And from my understanding, the main issue with what was going on was not an issue with marginfi, but with marginfi's like sort of design and risk management and the issues on Solana. So the reason you couldn't withdraw is because if you withdraw collateral and you have like a position open, for example, um, the protocol needs to determine whether your borrowed position would still be effectively collateralized by your deposits after your withdrawal. And the issue is they use, I believe it's like the Pyth Oracle. So the Oracle spits out a price that tells you the value of your collateral. If you have enough, like you can execute a withdrawal. However, in times when Solana's performance was degraded, they had a decent amount of issues with stale Oracle pricing, meaning like the Oracle wasn't updating in time, or like the Oracle did not provide like an accurate price feed based on your collateral. And this compounded with the fact that like a lot of transactions themselves weren't going through, caused some issues on marginfi. Now, like I believe Camino and Solana have like slightly different models. So in theory, they were operational at the time marginfi wasn't operational. And there are a lot of people like with their pitchforks out on Twitter claiming it was a scam, comparing it to stuff like Luna and FTX, saying like, well, if we can't withdraw, this protocol is a scam. I will say this though, I don't think marginfi responded to the criticism very well. That they were getting a little bit angry. I think it centered around Edgar, which is like one of the founders and main developers. Basically, he did some stuff to troll like the user base, troll the community, and eventually he said like he said something to the effect of like I don't think marginfi should give an airdrop to these people that like are being assholes to me on Twitter. He eventually gets fed up with the criticism and sort of just rage quits one day. I don't know if the issue is like what happened online, or if there's more to it, if there's something in the back end that I don't know about, but eventually he rage quits. So like I just wanted to say a few things about this. It sort of shows like the lack of understanding of people using these protocols, because they're basically responding to only what works for them and what doesn't. So like an example is if you're using, let's say, Solana and you're using marginfi, and you can withdraw from Solana, but you can't withdraw from marginfi, then immediately like the thought is Solana is a better protocol because like one works and one doesn't. However, like the technology and the constraints might be protecting you. So for example, if the Solana like Oracle pricing for collateral isn't as reliable as the marginfi one, the Solana. I'm not saying this is the case, just an example, but if like the risk parameters are set differently, there is a world where an exploit exists in all these borrow-lend platforms due to like these issues on Solana, and Solana gets exploited, but marginfi doesn't. Then people will come back and say, well, clearly Solana should have protected from this, and marginfi is the better protocol. It just sort of shows to me that people aren't really thinking about what goes into running these protocols, and sort of just like are results oriented. Like every protocol is inherently safe until it's exploited, and then it's a risk. The certain risk controls that some protocols put in, you can deem not necessary, but until something happens, like I guess the judgment is still out. And I sort of feel bad about the situation from Edgar. I know he I'm not defending his actions in any ways. Like I felt like he could have handled things better. But I realized like people in this space like were like he's obviously like a thoughtful, very intelligent dude. He comes from traditional finance. He understands like protocol design, risk management, stuff like that very well, like more than almost anyone in the space that's building stuff like this. but in the end of the day, I think we're just, we're all human, and if you're in the spotlight and you have like thousands and thousands of users that are like attacking you, like shitting on you every time you log on, I can understand how that becomes draining. So yeah, it's understandable to me, how the whole situation devolved, and it's kind of unfortunate. Well, with that being said, like I still think that there's very little risk in marginfi, especially compared to its competitors on Solana, and like the public sort of exporting them not handling this public situation correctly with like the protocol is a scam. It's very risky. You should pull your liquidity is a little bit unreasonable. The final thing I wanted to mention, I wanted to give out to my friend, give a shout out, sorry, to my friend Kobe, for launching Echo. I believe the site is echo.xyz. I know he's been working on it for some time, and I think it's a good, um, I think it's a good change of pace for crypto, especially in like this VC dominated field. So the idea of Echo is, instead of having like the token supply of like these new good projects being like sucked up by VCs and then dumping on retail. Essentially, if you onboard with them and then you have like a certain group or a certain syndicate that you follow, that you trust, that you believe in, you can invest with them. I believe the platform is fully KYC. You might have to go through some accredited investor checks. But I think it's a step in the right direction, just because a lot of the venture capitalists are very profit driven, and I don't know how much value they actually add to the crypto as a community, as a product, as a service. I think the real value in crypto is it's the user itself, like the people actually using crypto on a day-to-day basis, like using these protocols, testing out these protocols, providing liquidity, trading on chain, stuff like that. And I feel like, even more so in like the past like 6 to 12 months, the venture capital led investments and like the token designs and stuff like that have been a real leech on the whole crypto economy as a whole. Like you have these allocations of tokens at like a lower valuation. They're basically cornered. They do have some vesting, but a lot of these vestings can be sold. And then you have like a sort of unfair distribution of the tokens, just because like these venture capitalists were in early, and only, I guess, the only thing they really provide is the initial capital, and then maybe some consultation, maybe some advice. But other than that, their value, I believe, is pretty minimal. So it would be nice. I would love to see Kobe and Echo succeed. I'd like to see like a lot of good deal flow there that's offered directly to the public, directly to the users of the protocols, that the platforms, retail, rather than this intermediary step where like the VCs get early allocations because that they have the funding, and that they essentially use retail as exit liquidity in order to dump their positions. And if you're in retail and you don't have access to this deal flow, but you want to invest in a certain project, you're essentially getting at a much worse valuation than if you just invested directly with them, and it's at the profit of someone else who isn't really contributing that much, in my opinion, to the project itself. So yeah, if you're interested in investing, or like running a syndicate or helping out, you can go to the Echo Twitter page, or I believe the site is echo.xyz.com, and onboard. It might still be in beta. I'm not sure. They might have invite codes, but I'm sure someone can provide you with an invite code. Yeah, so that's about it. I'll get to some Twitter questions. I copied and pasted a few down. Let's see how many I can respond to before I run out of time today. Okay. First question. It's from Ormika, at Amicro, ACIMRO. Yes, FriendTech, are you LPing? Thoughts on use case? how it lands besides Farcaster, Lens, etc. I don't know that much about Farcaster and Lens, so I can't really compare with them. I actually don't even know that much about FriendTech, just because I haven't really used it. I just understand the general idea. I will say that them listening to the users and distributing, I believe, like 90% of the supply back to the users is pretty refreshing compared to, like a lot of the protocols giving like 5, 10, 15%. I believe there's like no vesting on these tokens. So it seems like a pretty fair distribution. The other thing I like that is inherent with the protocol design is that because it's like a social media cross with crypto, everything is transparent. So like, for example, if you like bought the keys of someone that promised to share their airdrop or share their distribution, um, it's transparent on chain whether they're sharing with their key holders or with their users or if they're not. Again, also like the distributions are transparent because like everyone ties an address with their account, so you can see which of the like the early users that got a pretty big following on FriendTech are actually bullish on the platform and either buying more or keeping their friend tokens, and which ones are selling. So I think that creates like a pretty interesting dynamic, and it sort of publicly shames people for going against their word. Like, for example, if you see an influencer shilling whatever project, it's not really transparent like almost 100% of the time whether they're like actually holding on to the equity or the tokens within this project, or are they just like shilling to pump the price and then dump on you. But I think FriendTech, in a way that it's designed, is a bit different, where like now you see people once they get the token, what are they doing? Are they holding on to it? Are they distributing it to their followers? Or are they just like dumping for profit? And that sort of creates at least some sort of accountability, which I think is important. So I sort of like the design. What's the rest of the question? Are you LPing? No, definitely not LPing. I would say that like regardless of APY, I haven't even looked. But regardless of APY, LPing in like a pool two like this, historically speaking, you lose quite a bit of money more often than not. So it's not worth the risk. Um, Long term, I'd say I think the jury's still out. Like the positive things, like I said, are like a fair distribution, decent use case, a decent number of people that are like known in crypto or have a following are using it. But I don't think the idea is like that novel or not easily replicated. I don't think that technology is anything special. Um, there isn't that much competition in like the whole social fi space right now, but in the future, I can definitely see a world where like it's definitely not number one or within the top five, but I'm not completely sure. Next question, Carnivore Cath, screen name Cathnivore. What meta is going out of style and what is incoming? And what are some popular CT theses you think have got invalidated hard at this point? Good questions. What metas are going out of style and what's incoming? I think the one meta that's going out of style is like the points airdrop meta. I think it's going to be done soon. The main issue I see with it is that it's still in like a closed loop environment. Like basically, there's going to be like a lot of unlocks, but there isn't really external money coming in. So people are sort of like within this system where no new money is coming in, but like just like new tokens that have value, and that they're going to be unlocked eventually, and there's going to be a lot of sell pressure. I feel like the situation is like going to be like a pressure cooker where like the pressure increases on the system as a whole every time there is a new unlock, to a point where like there's going to be a lot of disappointment when some of these tokens unlock and people realize that they're like worthless or next to worthless, just because that there isn't like this inherent outside money coming in to support the system. And then in the future, people will probably use their liquidity for something else, that they won't participate in these long-term points and airdrop programs as they did in the past. Like the reason the meta exists today is because you look at like a lot of the recent airdrops, and they have like pretty high valuations, and they like if you were farming those airdrops, you did really well. But for that to be sustainable, like eventually there needs to be external money to come in to support like the market cap, to support the valuation of all of these projects, especially the new ones coming out. If not, it's essentially just like printing money out of thin air and giving it away, which I think is what's mostly going on right now. So yeah, once a lot of these projects flop, or a lot of these points programs end in disappointment, I think the meta goes away pretty quickly. What's incoming? I'm not exactly sure. I would love to see something that's something like more sustainable, more use cases, more native or natural yield in crypto. Like you're making money because you provide a service, or you're doing something that someone is willing to pay for. And less of this current like PvP, trying to game the system, trying to like find the greater fool in order to make money. That's what I hope is incoming, but I'm not so sure. I mean, if I could see the future, that'd be great. Second part of the question: what are some popular CT theses that you think already gotten validated hard at this point? I think that this is going to be controversial, but the ETH L2 narrative, yeah, I just don't see it playing out like the way that the Ethereum crowd sees it playing out. But basically, the narrative or the thesis is ETH will grow into this like juggernaut, just because there'll be like tons and tons of L2s that are using ETH L1 for settlement and security. But if you look at like the recent, I think Starknet is like a very good example of this. A lot of people were using Starknet just to try to get some of the Stark token. The daily active users went down, I want to say like 95 to 98% after the day of the airdrop, and like right now it's like a pretty dead chain. And I feel like Starknet is one of those L2s that has been, I wouldn't say shilled, but like actively talked about, and as like one of the best pieces of technology on the Ethereum tech stack. And it's been like a pretty big dud. We still have something like ZK Sync coming out. I don't know how that's going to play out, but if it plays out similarly to Starknet, it sort of like invalidates a lot of the future L2s that are going to be that they're going to have a native token, that they're going to use Ethereum, and that they're going to attempt to build like a robust environment, especially now where we see like a lot of alternate L1s with, like different technology that offer like a different user base, a different tech stack, stuff like that, really competing with L2s on Ethereum. I think for sure that thesis is invalidated. A few others, so let me think about this. Yeah, like the whole, I don't know if this is a meme or a thesis, but like the institutions are coming. I'm not sure if that's the case. I think the way it's played out on like the ETF side of things with Bitcoin has been a little bit underwhelming. Like we saw like a huge influx of inflows like within like the first like few months, and then it's been a little bit stagnant. Some days like outflows, stuff like that. The ETH ETF, I believe, is unlikely to happen at this point, considering how tough the U.S. government is going after crypto companies. Like I think they had some new issue with Coinbase. They issued a Wells notice to Robinhood. It seems like they're really stifling this narrative, and they're going to make the regulatory landscape more difficult for institutions to be able to deploy capital at like a very high rate. So I don't think that's coming anytime soon. Other than that, I don't know. I think crypto gaming has been a bit of a disappointment. I don't know if that narrative is still like a thing. but there was like a popular thesis that like there's going to be like a robust ecosystem of crypto native games using like either like NFT or like certain ERC20 or ERC 721 standard tokens to transfer assets within the game. And I haven't really seen like that many games that have executed this well, and even less of those games have also like developed a game within and of itself that has like longevity, that doesn't have like this inherent shitcoining and like farming for profit rather than playing the game for enjoyment. And it's been quite some time. Like these projects have been funded years ago and have launched products, and like a vast majority of them have been extremely underwhelming. So yeah, I think that narrative is kind of dead at this point. Next question. Elston Gunn, screen name Jaggy3230. Where's Mantle going to be in a few years compared to other L2s? Aside from its treasury, how does it differentiate itself from other L2s? In my opinion, it's a bit different. I mean, like the treasury is a big thing, but like the team, the execution, like what they're doing, it feels to me at least that it's being built organically. Like they didn't run like huge airdrop campaign for anything. They built their own native LST and they incentivized use for the LST. It grew from basically nothing to I think like the third or fourth biggest LST in like a matter of like a month or two. A lot of the protocols that they're building on the chain or incentivizing on the chain aren't like copy and pasted versions of like something like Aave, where obviously they can incentivize that they have like the capital, that they have the money, that they can incentivize something like Aave to deploy on Mantle. But Aave is already deployed on like basically every EVM chain, so it seems like sort of a waste. Like you don't just because like you have these flagship protocols building on your on your chain doesn't necessarily make it um, strategically better, or like it doesn't really incentivize users well like incentivizing like smaller teams to build more native protocols without like the baggage of like a legacy token. I think is a good way. Yeah, so I think to answer your question, where it's going to be in the next few years, I think it's going to be within the top like five, maybe within the top two or three. If you look at like all metrics, whether it's TVL users, stuff like that, and I don't know how much it's really going to grow, but I just think of the TVL and the use for a lot of these like farming chains, like Manta and like Barachain, Blast, and stuff like that, sort of falls off when the whole like airdrop farming meta falls off. I feel like that the TVL of these will go down quite a bit, and people will look to chains that like feel more sustainable, that have like good protocols, that good incentives, that aren't like promising like these huge gains, but are actually generating real yield on chain. I know like a lot of protocols, a lot of what they're developing there is like their LST is METH. They use their treasury to incentivize double rewards on it. They're building out like I believe Mantle reward station. Basically, it's like a launch pool type thing where you can stake your Mantle and you get some allocation to certain projects on it. So the first one was part of the Ethena Shards campaign. The second one I believe was like Miso Finance, and I think they have like a few more lined up. So yeah, I feel like I'm ranting at this point, but yeah, I just think like I believe in the team. I believe in their execution. They seem to have like a long-term vision for the chain rather than just like building something up huge with like huge TVL only to be disappoint users later. So because I feel like the growth on Mantle is more organic, less forced than quite a few other L2s, I think it'll outlast them by quite a bit. Next question. I'll do a few more. Mojito GMI at Mojito GMI. Um, this is a bit of a lot of questions, so I'll answer them one by one. Risk of shorting high float, low FDV coins. I'd say the risk is in their nature, the high float, low FDV coins. A lot of the supply is concentrated among insiders, and the markets may not be as liquid. So you deal with something like market manipulation, short squeezes, insiders sort of controlling the price. So like whenever like the funding rates get pretty high, and I think that's the other risk, is that a lot of the times when like you think something is an obvious short, it's going to be like a very crowded trade, and funding is going to be like very high. So not only are you risking, not only is it very expensive to make the trade, but you're also risking, like sudden movements in the price of the token. Just because like the idea is because it's like I think you wrote it wrong, by the way. I think you're asking the risks of I was reading this, sorry. I think you're asking the risks of shorting a high FDV, low float coin, meaning like the fully diluted valuation is big, but like the current float is small. But you wrote high float, low FDV coin. Either way, yeah, I think the risk is just like the market being illiquid and there being sudden market moves, and like the trade being pretty crowded. Next question is on EigenLayer, Airdrop, and Whitepaper. Yeah, I read through it. I think their Airdrop design is fine. It probably pisses off a lot of people, but like, yeah, sure, whatever. Um, well, I guess one issue I think they will have in the future is if they get to such like a high valuation, that their token valuation as like what the futures markets are trading at, um, there's not going to be that much demand to justify the valuation for AVS or actively validated systems, basically like the use case for EigenLayer. Other than that, like a lot of the white paper like went over my head, so I can't really comment on it. But the token locks investing seems fine to me. They seem to like care a decent amount about like the community. That they're incentivizing like decentralization, self-staking, stuff like that, that they don't necessarily need to. Um, and I feel like their interests are pretty well in line with like the interests of like Ethereum and the like Ethereum ecosystem in general. Next question. LayerZero filtering of addresses. I think I covered this a little bit in the LayerZero talk, but I think the verdict is still out. I don't know how they're going to execute it, but I think they're going to do their best, and they're clearly responsive and trying. And I think it is a big issue for all these projects that they do need to address, because a lot of the people sibling these projects and extracting value from these projects are directly taking value from the people that are like actively using the protocols, and actually contributing a value to the protocol. So it's in a protocol's best interest to incentivize the people that like have the best chance of being long-term users that are actually like using the technology, testing it out as intended, rather than just like attempting to game the system in order to generate yield, or to generate as much of their native token as possible. So like I'd say in general, I like what they're doing. I like incentivizing other users to actively participate in reporting addresses that may have violated their terms and services, just because it involves the community. It's all incentivizing the same thing, right? Like the end goal should be, we as a protocol, when we airdrop our token, we want to airdrop our token in the fairest way possible in order to incentivize the users that like we want to keep, or we think will stay on and use our protocol for the technology that we built. And yeah, I have a lot of faith in them that they'll execute this very well. How would you do an airdrop? That's a good question. I guess it depends on like what the airdrop is and like how the protocol is designed. I'd say in general, I would side towards something close to fully linear or I don't know, like basically anything to stop sibling as much as possible. And like I said before, to incentivize users. I'm sure there are people like way smarter than me that like are thinking about these things more than I am. But yeah, like that would be my end goal. Probably just like as linear as possible. It doesn't necessarily mean that like I'm filtering out like the small users and only incentivizing the whales, but like the flip side of that is like the whales that use a protocol and do high volume are far more valuable than a group of you know small retail players doing like microtransactions. So in theory, like a lot of the whales deserve to be compensated like far more than like smaller individual users. So yeah, I'd say like yeah, fully linear, stop sibling as much as possible, incentivize the users that like are doing real transactions, are doing real swaps, or doing real whatever as much as possible. Final question in this is where are we in the cycle? I have no idea. I legitimately have no idea. All right, I'll do two more. Martin J at Martin JE. How long is this low float, high FDV meta last? Um, Yeah, that's a good question. I think I touched on it like quite a bit, just because there isn't like that much outside money and like these unlocks will eventually happen. It feels like to me it's like a pressure cooker ready to burst. I'd say that the meta still lasts, just as long as there's VC money still flowing in, because essentially this is from an outsider, but this is my perspective. Is that like I think the playbook is more um, developed by the venture capitalists who are like funding these early stage projects. Like the projects themselves aren't really like these masterminds like tokenomics. That they're developing like real technology and stuff like that. But like you get a large check from a VC that they might have influenced and that they want to figure out a meta where their investment profits as much as possible. So I think like the structure will last just as long as there's like still new VC money flowing into these projects and they have some say as to the token design, the airdrop, and stuff like that. Um, but other than that, I don't think it lasts like too much longer. Just because like I know it's become a meme at this point, but like eventually these tokens will unlock, like the vesting cliffs will happen. Like there's going to be a limited amount of liquidity where you can sell OTC at a discount and stuff like that. And like these tokens will eventually hit the market, and then like people will look back and say, well, maybe this wasn't like the best idea for our protocol because now like our token looks like it rugged all its users and it's gone down like 95% during this vesting cycle, and then possibly like new protocols or new teams will be more privy to maybe the meta changing and maybe not do this with their token. Next part of the question is 55% plus for the Team VC standard now. I don't know what's standard, but it sure seems that way, judging from like the projects that are launching. I believe like maybe like 5 to 20% distributed to like the public in forms of points or airdrop. Um, yeah, I don't think there is much of a standard for this. I just think that it's just like an internal thing where like the founders and the VCs discuss the tokenomics, and the VCs probably have quite a bit of input as to how to design the token, and that they have experience being VCs in other projects. So then you see sort of like similar token distributions, similar tokenomics among all these projects that have essentially the same or like a similar group of venture capitalist founders or venture capital firms that invest in them in early stage of their project. Next question. That'll be the last one. I think we've gone long enough today. Javier Wang at Durr. What do you think that interoperability cross-chain bridge tokens will ever catch another bid? W, which is the wormhole token, so far has been a massive flop. LayerZero could be headed that way off of CT sentiment. Personally bearish on them going forward. Liquidity fragmentation and bridge governance tokens aren't hip. Yeah, I'd agree with that. So like one thing I'd say is I would separate like the value of something like LayerZero with like the market value of the LayerZero token on day one, because like I feel like those two things almost have nothing to do with each other. Like one is dependent on like the current sentiment and the current market environment, and one is like legitimately based on like the actual technology, the use, the adoption, and stuff like that. So there is very little overlap. Um, Personally, I'd say I'm probably bearish on a lot of the I guess you call them like cross-chain bridging tokens, just because like the essential use case is like people need to pay some fees to bridging, and then like a portion of the fees that don't go to like the bridge LPs will go back to the token holders. But yeah, I think it's going to come to a point where bridging is going to be, or the idea of how to bridge is going to be solved, and it's going to be like a race to the bottom. So if like for example, if like the LayerZero standard, or like wormhole is used universally, um, the actual like white labelers, or like the actual bridge operators are sort of in a war with each other to make fees as low as possible, because it's market like if you want to bridge from like one chain to another and you only have one option, you're essentially going to pay that fee. But if you have like 5 equally good options, you're going to choose the one with like the smallest fees. And even now there's stuff like, is this similar to how there's like decentralized exchange aggregators? Like you can input a trade you want, and it'll like route you to like the best DEX. There's bridge aggregators, which let's say you have a token on Ethereum and you want it on like Avalanche. It'll figure the best route out for you based on fees and the lowest price. So I think this sort of leads to a race to the bottom, where um, these operators will always have to undercut fees against each other, which means like it's a positive for like the average crypto user, because bridging from chain to chain will be like faster, cheaper, easier in the future with all this technology. But it's sort of bad for the native token if all the native token is doing is capturing a portion of the fees, because like the fees that are generated by like a bridge aren't necessarily related to the volume. I mean, they are, but they're related to the volume proportional to fees. So even if you 10x the volume on a bridge, but like in order to do that, you have to reduce the fees by quite a bit. It's not necessarily like a net gain for the token holders. Um, yeah, so I'm not going to FUD these tokens too much. I think there is a world where stuff like the wormhole token and LayerZero token do really well. But in general, it's not really in my like short or long term thesis to hold any of these tokens. Thinking that like they'll accrue value, or that they'll go up in any meaningful way compared to other assets I could be exposed to. And I think that's it. Answered a bunch of questions. Got a podcast done, so I don't owe a fine to my fan base. Yeah, I'll try to do more of these in the future. I'll find some guests. If you like this format, let me know. Maybe I'll do a few more of these, or if there's a previous format I did in the past that I haven't done in a while that you liked, maybe reach out to me and I'll see if I can do one. But I'll try to. Yeah, I was on vacation for quite some time and then just busy with work and stuff. But I'll try to like get more of these out in the future, just as long as there's something to talk about. And probably the next one, I'll, have like a guest or two on that I've been meaning to do that I've been putting off. Um, other than that, appreciate you tuning in, and I'll talk to you guys later.